REF, SRC, stroke TS, stroke JE, stroke SRCS, stroke 3, stroke 33, stroke 4, volume 1, volume 9, in bracket 106, dated 19 August 2020, approved the salary structure for Agricultural and Food Authority, which was to be implemented from 1st July 2020 without backdating of the salaries. However, the corporation had requested for the consideration of unharmonized arrears dating back to when the corporation was formed, and therefore initiated an appeal for the consideration of salary arrears accrued from an harmonized salary structure from 2014 until harmonization of salaries in 2020 through letter REF AFA stroke HRM stroke 7 volume 5 in bracket 6 of 11 October 2023. In this regard, the board held its first meeting on 16 May 2023 and gave the matter consideration. However, the AFA is still negotiating for the arrears to be considered and be approved by SRC 5 years since the initial SRC approval. In addition, the probability of outflow of this amount is uncertain, yet it has been classified as a provision. Management acted contrary to the Salaries and Remuneration Commission Circular REF SRC stroke TS stroke JE stroke SRCS CSCEC stroke 3 stroke 33 stroke 4 volume 9 of in bracket 106 dated 19 August 2020. In the circumstance, the accuracy and occurrence of the current employees benefit obligation of Kenya shillings 1,257,386,000 could not be confirmed. The next observation, Chair, is long outstanding payables. The statement of financial position and note 28 to the financial statement reflect trade and other payables balance of Kenya shillings 663,873,000. However, review of the Horticulture Crops Directorate aging analysis revealed a significant balance payable to Kenya Airport Authority totaling to 156,437,152. The amount represents approximately 23.56% of the total payable, indicating a significant concentration of liability owed to a single service provider. Such a significant outstanding balance on one supplier may expose the entity to service disruption risks, potential penalties, and questions regarding the adequacy of its payable management practice. The other observation, Chair, is found on page 6. Is construction and equipping of hot water treatment plant at Nairobi Horticulture Center. The authority awarded the contract of construction and equipping of hot water treatment plant at Nairobi Horticulture Center through contract number AFA stroke LM stroke CON stroke 23 stroke 2022 at the contract sum of 85,313,348.38.
Can we get the figure right? 300 and
85 million 319
correct.
Million 319,345.38.
Correct. The initial one was wrong. You had read it differently. Proceed now, it's correct.
The contract was supposed to run for a period of 5 months from the signing date of on 22 June 2022. The project commenced on 14 July 2022 with an initial original completion date expected to be 17 January 2023. The following additional anomalies are detailed below. Roman 1. The contractor requested for extension of contract period for 6 months on 1st February 2023, stating that 1st January 2023 to 30th June 2023, stating that the delayed payment of certified works caused the project to stall. The project manager granted the extension on 26 April 2024. Further, the second extension was requested on 29 June 2023, extending the completion date from July 2023 to 30th November 2023, which was extended from 1st October 2023 to 30th November 2023. The project manager issued the default notice to the contractor on August 2023 for abandoning the site without notice. The contract period was further extended with 8 months from 1st December 2023 to 31st July 2024. Roman 2. Review of minutes of Project Implementation Committee revealed that there was no clear justification from the technical department for variation of contract in writing, backed by supporting evidence and submitted to the head of the procurement function for processing. In addition, Public Procurement and Disposal Act 2020, Roman 3, the concept note on establishment of hot water treatment facility for Mango at Nairobi Horticulture Center, in bracket NHC, dated 20 December 2021, to Principal Secretary, National Treasury and Planning, indicated that the estimated cost of the project was 79 million. The amount was to be financed by the government of Kenya, was Kenya shillings 54 million, and 25 million by development partner. However, the project costs have been funded from initial internally generated funds. Further, the successful bidder quoted a price of 88,505,545 as per the bill of quantity, thus exceeding the engineer estimate cost by Kenya shillings 9,505,545. Additionally, the price was further negotiated, hence revising the tender price to 85,319,345.38, inclusive of all taxes. Roman 4. The original contract period expired on December 2022, and the extension of contract period was done through letters. However, the addendum extending the original contract period was not provided for audit. There was no binding contractual agreement existing between the contractor and authority as per the time of the audit. The performance bond issued on 28 January 2024 expired on 30th May 2025, contrary to PPDA Act 2015 and regulations which require performance security to be returned to the successful tenderer within 30 days, following the final acceptance by accounting officer of the procuring entity, and in case the contract is not fully or well executed, the performance security shall unconditionally be fully seized by the procuring entity as compensation without prejudice to other penalties provided by the Act. Roman 5. Physical verification carried out in June 2025, the project was still not complete, and there was no evidence for extension of the contract period, and the contractor had abandoned the site. In the circumstance, the delay in completion of the project may attract unavoidable cost due to price fluctuation of the equipment and possible loss of funds, public funds, through abandonment of the incomplete projects. The other query of observation, Chair, is delay in renovation at Coffee Plaza Building, Exchange Lane, at Haile Selassie Avenue. The Agriculture and Food Authority entered into a contract for provision of renovation service at Coffee Plaza Building, Exchange Lane off Haile Selassie Avenue by contract number AFA/CON/6/2024 at the contract sum of 58,613,685 for a period of 6 months. The site was handed over on 5th August 2024, and works commenced on 2nd September 2024, which expected completion date of 20th January 2025. However, the following observations were noted. 2.1, extension of the contract period. Examination of records provided for audit revealed that the contractor on 9 January 2025 requested for extension of contract period for 10 weeks, citing delay due to issuance of electrical drawings, handing over of 8 floors, and additional works not in the initial scope. However, the project manager recommended the extension of the contract period on 20th January 2025 from 20 weeks to 25 weeks, revising the completion date to 24th February 2025, which was approved by Director General on 20th January 2025. Further, the contractor filed letter dated 11 February 2025, 13 days to the proposed completion date of the contract, submitted another application for extension of the contract period for another 8 weeks, in which only 7 weeks was granted on 21st February 2025, extending the contract period from 20 weeks to 33 weeks, which revised completion date of 23rd April 2025. However, by the time of audit in May 2025, the contract was still ongoing. In the circumstance, the delay works may attract unavoidable cost due to price fluctuation and possible loss of public funds. Second last chair is about rehabilitation of Nzoia Sugar Company. 3.1 is delay in delivery of machine.
How about 3.2?
Oh, 2.2 chair, sorry.
2.
Is budget allocation and approval.
Yes.
Review of procurement plan and approved budgets for the financial year 2024-2025 revealed that the expenditure on refurbishment work totaling to 58,613,685 had not been approved. Further, the supplementary budget was not provided for audit to demonstrate how the unapproved amount was regularized. In the circumstance, the unauthorized expenditure and failure to provide supplementary budgets for audit review may lead to loss of public funds. Our second last chair is 3, that is rehabilitation of Nzoia Sugar Company. 3.1, delay in delivery of machine. The statement of financial performance reflects the disbursement of Kenya shillings 1,475,023,000, and as disclosed in Note 13 to the financial statement, includes Kenya shillings 256,599,000 disbursed to Nzoia Sugar Company, which further include 46 million for the rehabilitation of sugar processing plant through the procurement of key equipment and replacement of obsolete parts. Further, an amount of Kenya shillings 43,419,529 was issued to procure mill rollers and boiler tubes. However, examination of records provided during the audit verification revealed that the factory procured part of processing machines, including blank mill roller shells, through tenderers initiated in May 2022 and boiler bank tubes in December 2024 and fully paid. Physical verification in July 2025, 6 months later, the machine had not been delivered to the sugar company, and management explained that the machinery had been imported into the port of Mombasa, and no proper explanation was provided to why the machinery was to be delivered to the factory. In addition, it could not be confirmed whether the new investor will make use of the machinery once delivered and installed, since the company had been leased to a private investor for a 30-year lease term, and whether the lease agreement took into account the cost of the imported machinery. In the circumstance, the delay in delivery of machine may attract unavoidable cost due to price fluctuation of equipment, and unconfirmed use of new investor may lead to possible loss of public funds. The last observation, Chair, allow me to take water.
Yes.
Thank you, Chair.
Water is life.
The last observation, Chair, is on property, plan and equipment. That is 4.1. Is failure to operationalize cane testing unit. That is CTU.
25 of the response, 2.5. Proceed.
Failure to operationalize cane testing unit, that's CTU. The contract agreement for provision of comprehensive support and maintenance service to 11 testing units between Agriculture and Food Authority was entered on October 2023 by contract number AFA/LM/CON/60 2024. The contract was to run for a period of 3 years from 25th October 2023 to 24th October 2026. During the first year, the authority was to pay the contractor amount not exceeding Kenya shillings 406,037,942, and subsequent second and third year would be agreed upon by both parties in writing at the end of first year. Further, addendum to the contract for provision of comprehensive support and maintenance services to 11 Kane Testing Unit software license was signed on 6 November 2024 via contract number AFA/LM/CON/60A/2024 at an annual cost of 446,552,206, inclusive of all taxes, for the period of 1 year running from 25th October 2024 to 24th October 2025. Review of the letter from supplier to Director General Agriculture, Food and Authority dated 28th October 2024 indicates that the second year contract value was Kenya shillings 470,054,950, but was discounted at 2.5%, which is applicable in the second year of the contract. Further, the authority incurred a cost of Kenya shillings 178,628,55, being 40% of the contract sum, for the provision of comprehensive support and maintenance service to 11 Kane testing and software license for the period of the second year of the contract Kane testing unit, period covering 25th October 2024 to 24th October 2025 on 11 December 2024, via payment voucher number 16345. Further, the supplier was paid 60% of the contract sum of Kenya shillings 267,931,351 on 29 December 2024, via payment all totaling to Kenya shillings 446,552,202. Further, audit verification in the month of July on the operation of Kane testing units observed the following. Roman 1. Lack of legal framework to operationalize the Kane testing unit. The 11 Kane testing units were installed in the sugar companies, and calibration of the equipment was done but not operational, since the sugar in bracket quality-based sugarcane payment system in bracket regulation 2025 had not been enacted. Therefore, there is no legal framework to anchor the rolling out of cane testing units. In the circumstance, lack of legal framework to operationalize the cane testing units implies that the set objectives may not be achieved. Roman 2, uncertainty time scale for accreditation of wet and dry laboratories. Verification of the installed sugar cane testing unit within the South Nyanza Sugar Factory, that is Sony, and Chemelil Sugar Factory, Moroni Sugar Factory, and Soia Sugar Factory established that the cane testing unit are not in operation. Further, the wet and dry laboratory are yet to be accredited by Kenya Accreditation Service, in bracket KENSA, due to the following pending requirements. Roman 1. Lack of a quality manual, procedure, and policies on operationalizing sugar cane testing units. Roman 2. Incomplete result of successful participation in proficiency testing in tests applied for application. Roman 3. Resumes of nominated technical signatories. Roman 4. Mandatory procedure and documentation as required by ISO/IEC 17025 2017 on testing laboratories and calibration laboratories, process for accreditation. Roman 5. Outline an identification of key areas of risk and develop a risk register with mitigation strategies for cane testing unit. Roman 6. A cross-reference matrix to standard requirements showing proper mapping on the compliance against the set standards. Roman 7. Evidence of legal entity status of the client. Roman 8, evidence of staff having been trained on the requirement of ISO/IEC 17025-2017. Roman 9, a complete periodic internal audit and management review conducted prior to accreditation assessment to ensure compliance and integrity/quality of the system. Roman 10, 5-year proficiency testing schedule for testing/calibration laboratories. Roman 11, effort to satisfy all other relevant ISO/IEC standards/guide and any international interpretation thereof, and requirement to enable the assessment team to make positive recommendation to the accreditation committee, that is AC. In the circumstance, lack of delivery accreditation of wet and dry laboratories may hinder project delivery on time. Roman 3 of the observation chair, lack of integration of LMIS and weighing bridge system. The cane testing unit are yet to be integrated with the existing factory enterprise resource system, weigh bridge and laboratory information management system, that is LIMS, due to issues of incompatibility. These are further hampered by new leasing of sugar factories to private owners, while the cane testing units are still under Agriculture and Food Authority. There are no guidelines on how the CTUs will be acquired, operated, and maintained forthwith with the new factory management. In the circumstance, lack of compatibility of the integration of LMIS and weighbridge system could delay completion, and the objective of the project may not be achieved. The final observation chair, Roman 4, inadequate personnel in cane testing unit laboratories. The sugar cane testing units are also incapacitated in terms of the numbers of personnel in charge of the laboratories. All the cane testing unit visited for verification had only one staff in charge who was carrying out all the activities within the lab, which is in contrast with the CTU operational manual guides that no one should work alone in the laboratory. A resumption of full adoption and operationalization of the CTUs will require more laboratory staff to enhance efficiency in operation and expected output from the laboratory. In the circumstance, the set objectives for the CTUs may fail to be achieved and the value for money may not be realized. Thank you, Chair.
Thank you. I hope the small cup of water helped you. So let's invite the Vice Chair to introduce himself.
Thank you, Chair. Good morning, everyone. My name is Caleb Wamisi, MP Saboti, Vice Chair.
We're also joined by the Deputy Director, Audit.
Thank you, Chairman. My name is Oscar Namlanda, Deputy Director, Audit Committees.
CEO, you can take us through the responses.
Yeah, thank you, Chairman and honorable members. I will respond to the first query. It's a confirmed revenue from exchange transaction amounts.
If you don't mind, since you are reading the responses, you give us the pages on the response, so that you...
The first response on page 3.
Correct.
Yeah, the management acknowledges the auditor's observations regarding revenue from exchange transactions. However, the reported revenues from exchange transactions of Kenya shillings 5,272,614,584, including levies, licenses, fees, penalties, and transfers from other government entities, are captured in the books of the authority and supported by Appendix 1, Roman 1, and summarized in the financial statements as tabulated below. In the description, under levies, fines, and penalties revenue, the amount reported in Kenya shillings was 4,128,190,554.
I think for the table, you can just as per the table, then we move forward.
Thank you, Chair, for that. So the reconciliation between the authorities' records and e-citizen PESA flow reports has been undertaken and no material variances were noted. In Roman 1, Chair, the authority maintains revenue schedules, reconciliation statements, and supporting documentation obtained from the respective collection platforms to support the verification of completeness and accuracy of revenue recognized in the financial statements. Management confirms that all revenues collected on behalf of the authority through the National Treasury via e-citizen or PESA Flow platform, as well as the collections processed through Kentrade, have been duly accounted for and accurately reported in the financial records. However, the reconciliation process is occasionally affected by delays in accessing real-time reports from the respective platforms. The authority is in the process of upgrading the Integrated Management Information System, that's licensing platform, to enhance system interoperability and facilitate seamless integration with Kentrade and e-citizen. The upgrade is targeted for completion by December 2026. In Roman 2, Chair, management acknowledges that detailed transactional reports containing customer data, invoice numbers, and sequential flow of receipt numbers were not accessible at the time of audit. Following engagement with the National Treasury officials, the authority has since obtained access to the detailed transactional reports. A sample of the detailed customer level report is attached in Appendix 1, Roman 2. In response, Roman 3, the total income of Kenya shillings 655,000 includes inspection service charges, rebilling charges, and fees collected by various directorates. Supporting schedules showing the breakdown of Kenya shillings 655,000 by directorate with invoice numbers, customer details, and descriptions of service rendered are also attached in Appendix 1, Roman 3. Below are the, in Appendix 1, we have a detailed schedule of revenue received, where A, we have levies, fines, and penalties, which is on page 5 to 28.
We'll go to revisit them. Let's just go to the receivables, the second one.
Thank you, Chair. In the receivables, the management would like to respond as follows.
Yeah, that's
Page 5. Page 5. Management acknowledges the auditor's concerns regarding the recoverability of aged receivables and the non-enforcement of paragraph 7.5 of the authority's finance policy and procedure manuals of 2018, and responds as follows. The management acknowledges that the provisions of paragraph 7.5 of the finance policy and procedure manual of 2018 were not enforced within the stipulated timeline. This was primarily because certain dates were subject to ongoing legal proceedings, government-to-government negotiations, or review by technical committee appointed by the Cabinet Secretary, which precluded unilateral enforcement action by the authority. Management accepts, however, that this should have been expressly documented and reported, and commits to ensuring that the rationale for any departure from the policy manual provisions is formally recorded and escalated to the board. The authority has undertaken various debt recovery initiatives, resulting in the recovery of Kenya shillings 7,378,179.59 to date. Further, the authority continues to actively engage debtors through the issuance of demand letters, as shown in Appendix 2, Roman 1, to facilitate recovery of the outstanding balances. Receivables amounting to Kenya shillings 895,839.97 and Kenya shillings 1,233,450 arose following the abolition of the sisal regulatory levy and coffee regulatory levy, respectively. These balances are pending write-off, subject to the requisite approvals. A receivable balance of Kenya shillings 196,630,816 relates to funds advanced to the former Pyrethrum Directorate prior to the transfer of its commercial operations to the Pyrethrum Processing Company of Kenya Limited, PPCK, as well as funds subsequently advanced directly to PPCK. The apportionment of the related assets and liabilities between the Agriculture and Food Authority and PPCK is currently under review by the technical team, a technical committee appointed by the Cabinet Secretary for Agriculture. This is seen in Appendix 2, Roman 2. The final treatment of this balance will be determined upon implementation of the committee's recommendations and approval. Management is also undertaking a comprehensive review and reconciliation of all aged receivables to assess their recoverability in accordance with the applicable accounting standards. Where recovery is deemed doubtful, appropriate impairment provisions and or write-offs will be processed in compliance with the provisions of the Public Finance Management Act of 2012 and other applicable regulations. A detailed analysis of the various data categories and the status of each outstanding balance is attached as Appendix 2, Roman 3. Chair, I would like to go to question 3. The response is on page 7. The management acknowledges the observation that the provision for salary harmonization arrears was recognized, notwithstanding the Salaries and Remuneration Commission communication that the harmonized structure be implemented prospectively. The board at its 7th full board sitting, as held on 28th September 2023, via minute number 5/28/09/2023 on the financial report for the year ended 30th June 2023, noted the management request on provision for personnel emoluments dating back to financial year 2014-2015 as part of the total liabilities for the authority. The board subsequently resolved and approved provision of staff salary arrears amounting to 1,248,827,582 for a period 1st August 2014 to that 1st October 2023 for salary and pension arrears. As directed by the board, management via letter dated 14th November 2023, reference AFA/HRM/7/volume 5, Folio 5, presented the request to the Principal Secretary, State Department for Agriculture, with a copy to the Cabinet Secretary, Ministry of Agriculture and Livestock Development, for onward submission to the Salaries and Remuneration Commission for consideration. Subsequently, the Principal Secretary, via letter reference MOA/A.11/10A/volume 1/14, dated 8th January 2024, submitted the authority's request to the Salaries and Remuneration Commission, SRC, for consideration, which SRC acknowledged and advised via their letter reference number SRC/TS/24/1, dated 10th January 2024, that the Commission is looking into the submission and will communicate the outcome in due course. The Salaries and Remuneration Commission, via their letter of reference SRC/TC/24/4/volume 7/77, dated 30th January 2026, deliberated and approved payment of salary arrears to staff as earlier submitted. The same was presented to the board for concurrence and adoption. The salary arrears have since been paid and out, amounting to Kenya shillings 1,141,739,247.29. Chair, for the next question is page 16. On the long outstanding payables, and the management would like to respond as follows. The management notes that the prior year audit issues were duly considered. The management acknowledges the long outstanding payables of 156,437,152 owed to Kenya Airports Authority, KAA. This amount represents accrued rent on the land at Jomo Kenyatta International Airport, JKIA, occupied by the Horticultural Crops Directorate, HCD, where the Directorate's headquarters and park houses are situated. As noted in the land table under query 4.1 above, the formal lease agreement between the authority as statutory successor to the Horticultural Crops Development Authority and KAA was never executed, notwithstanding the letter of offer dated 15th May 2000 and the authority's letter to KAA dated 3rd April 2023 requesting execution of a lease agreement. The authority is actively pursuing formalization of the lease, which will also provide a clear basis for quantifying and settling the outstanding rent obligation. The authority will formalize the lease agreement concurrently with the repayment arrangement to ensure the liability is settled and no further dispute arises as to quantum. The next query, Chair, is on page 18 on the construction and equipping of hot water treatment, and the response is on page 19. The management acknowledges the auditor's observations and responds as follows. On contract extensions, the first and second project extensions were done in accordance with the law by the project manager as required. The requests for extension originated from the contractor, citing delayed payment of the first certificate and other delays. The requests from the contractor were forwarded by the technical department to the procurement department for processing. On the project financing and engineers' estimates, let's go to page 20. The Kenya shillings 79 million in the concept note was an initial estimate only, subject to the preparation of a bill of quantities by the engineers. The project was originally envisaged to be jointly funded by the national government and development partners. However, neither the national government nor a development partner accepted the request to fund the project. The authority therefore utilized internally generated funds. The final negotiated contract price of 85,319,345.38 did not exceed the engineer's estimate by more than the 20% variation permitted under the applicable procurement law. In Roman 3, addendum and performance bond. An addendum to the contract was issued on 1st December 2023, reference number AFA stroke LM stroke CON stroke 24 stroke 2023. During the time of audit, the addendum was not availed as it had been misplaced. A copy of the addendum is now attached for the auditor's review in Appendix C1 Roman 4. It is confirmed that the performance bond expired on 30th May 2025. However, by the time of expiry, the authority had resolved to terminate the contract because the contractor had abandoned the site for almost 1 calendar year. As only the first certificate had been paid and no further payments had been made to the contractor, the authority's financial exposure was limited to the first certificate amount, which represents work completed and accepted at this stage. In Roman 4, contractor abandonment and new contract. A formal termination notice was issued to the contractor following the abandonment of the site. The contract was terminated at 57.77% completion rate. The outstanding work has since been tendered by a development partner, that's Trademark Africa, and the new contracts awarded valued at 65,265,851, and work is currently ongoing under this arrangement. Currently, all the building works have been completed and awaiting installation of equipment. Copies of the new contracts are attached at Appendix C1, Roman 6. So, Chair, thank you. I go to the next, page 21, on delay in renovations at Coffee Plaza Building, Exchange Lane of Haleslage Avenue. The response is on page 22. While the management acknowledges the auditor's observations and response as follows. In extension of contract period, the extensions were processed in accordance with the conditions of the contract, specifically Section 8.41, which entitles the contractor to extension of time subject to subclause 20.1. The second extension ended on 24th April 2025. The contractor, through his letter reference ML/AFA/OT/11/2023/007 dated 10th April 2025, wrote to the authority requesting a further extension, citing challenges which affected the project completion timeliness. The Contract Implementation Team, CIT, Committee, at its sitting on 18th April 2025, deliberated on the request and recommended a further extension of 9 weeks, which was approved. At the time of audit, the contract was therefore legally on course with a valid extension in place. The work has since been completed as per the attached final payment certificate in Appendix C2, Roman 8. On the
And also,
allocation,
should you require some water, there is enough water. I hope my officers can serve you with a glass of water.
there is a,
Yes.
yes. Thank you for that. On budgetary allocation, the budget for this project was approved in financial year 2023-2024. However, by the close of that financial year, the project was still ongoing and had not been completed. The total cost of the project was accordingly accounted for as a capital commitment in the books of the authority based on the signed contract, in accordance with the standard accrual accounting practice. The journal entries recording the capital commitment are attached at Appendix C2, 7, Roman 7. So the next query on page 23 on rehabilitation of Nzoia Sugar Company. The response is on page 24, where the management acknowledges the auditor's observation regarding the delayed delivery of machinery procured for Nzoia Sugar Company using funds channeled through the authority. In response, the authority formally requested a detailed explanation from Nzoia Sugar Company via letter reference AFA/ADM/73/volume, that is 2163, dated 14th August 2025, attached as Appendix C3. A response was subsequently received from Nzoia Sugar Company on 17th July 2026, clarifying the status of as follows. A. Nzoia Sugar Company initiated the procurement of boiler tubes and mill rollers in 2022 as part of its annual maintenance program. Christina Engineering was awarded a contract for the supply of black mill rollers at a cost of US $99,000, while Privilege Bixon was contracted to supply black boiler tubes at a cost of US $225,000. Owing to cash flow constraints, the Ministry of Agriculture facilitated financial support to Nzoia Sugar Company through the authority, resulting in the establishment of letters of credit amounting to Kenya shillings 43,419,529 to settle the suppliers. The procured items arrived at the port of Mombasa in April 2025. However, additional funds were required to clear the consignments. Nzoia Sugar Company subsequently requested support from the parent ministry through a letter dated 25th April 2025. Clearance of the consignment was not effected prior to the leasing of the factory, which occurred on 10th May 2025. Following the leasing of the factory, the new lessee, West Kenya Limited, undertook the clearance and installation of the boiler tubes. The mill rollers remain at the port of Mombasa, pending settlement of outstanding supplier costs. This is in Appendix C3. Then finally, Chair, the property, plant and equipment, where we have failure to operationalize cane testing units on page 25. The management response is on page 27, where the management notes the auditor's observations and responds as follows. In lack of legal framework to operationalize the cane testing units, management acknowledges that at the time of audit, there was no legal framework to operationalize the cane testing units, as the Quality-Based Cane Payment System, QBCPS, Draft Regulation 2025 had not been enacted. The regulations were approved by the Joint Agriculture Sector Steering Committee, SWAG, and subsequently presented to the Council of Governors for input and were subjected to the first round of public participation in September 2024. Once the regulations complete all required approvals, they will be submitted to the Cabinet Secretary for gazettement. The gazettement of the regulations will compel all players to implement or adopt QBCPS as envisaged. The process is expected to be completed in the financial year 2025-2026. In Roman 2, uncertainty timescale for the accreditation of wet and dry laboratories. Kenya Sugar Board management is committed to ensuring the wet and dry laboratories are accredited in financial year 2025-2026 and has engaged Kenya Accreditation Service in development of quality manuals and procedures, staff training on ISO/IEC 17025 of 2017, proficiency testing schedules, risk registers, and internal audit and management review cycles to fully meet the requirements of accreditation. On lack of integration of LMIS and weighbridge system, the Kenya Sugar Board management will appoint technical teams from Kenya Sugar Board and the factories to work on interface solutions between CTU systems, ERPs, weighbridges, and LIMS, with a pilot integration schedule in selected factories. Inadequate personnel in the Ken testing units laboratories, the Ken testing units have been transferred to Kenya Sugar Board, and we believe that they will really engage more staff to work in these facilities. Thank you, Chair, for the opportunity.
Thank you. It has been a long response. Thank you, colleagues. Thank you, CEO OAG, for those questions and responses. Allow me to open the floor. Bishop Akanti, you want to pray or you want to ask a question?
No, I want to contribute.
Please do. Proceed.
Thank you, Chair. First of all, the observation, Chair, on the presentation and response by the agency to the queries raised by Auditor General is quite fair to look at the face value. And also, much of the questions raised, Chair, is about an update. What have you done since then? Generally, that is what was required by these questions. I was only wondering why the finance department, because these are just technical issues, could not complete and give a complete answer to some of the areas, Chair. What would have been a problem? Because when you look at it, it was only a demand for an update. And the answers they already give indicates that they have information to that effect. And you can relate it, Chair, even with the attached appendixes that they have given. So maybe they would cite what could have been the challenge they are facing as an organization internally. Chair, thank you.
Thank you. CEO, what could be the challenge? Because by the time of audit, you seem to have had the responses. Only that when you are invited, you appear to have the responses. What has changed?
Yeah, thank you, Chair. Thank you for that question. Honorable Member, I would like to, with permission, to transfer the question to my Finance Director. Thank you.
Proceed.
Thank you, Chair and honorable members. In some of the responses, as we have gone through, for instance, the reconciliations, we had a challenge at that time to get some of these reports. We even had to now engage the National Treasury and to get access to the reports. That is why now we have the reports, but we couldn't avail them during the audit period. Some of this documentation, we've been able to get it after the audit. Thank you, Chair.
I disagree with you. That is too general. Let's be very specific and say which one, because about 4 issues, 4 audit queries have been well responded to now. And the audit is very current, 2024-25, meaning
Yes,
your team in totality was there. Actually, allow me to remove it from first the head of finance to the CEO. What could have happened? Do you have capacity issues? Have you improved your capacity now? Or what would have happened that time the audit papers were not there? Now today it's well elaborated that you have presented the issues before the committee. What has happened?
Yeah, thank you, Chair. Thank you very much for the second clarification. One thing I would like to say is that we had an able team, and during that audit time, we, as you said, one of the documents, especially when it comes to reconciling the eCitizen and PesaFlow, which really comes from Kentrade, is a third-party system, as well as PesaFlow that comes from eCitizen. We could not access the documents at that time until we had to sit down with them and demanded that they be sharing with us the documents at every time. However, we also see that we have a new lady in town. At that time, we had a gentleman who had just left. Mr. Wawiru, who was our director. So at that time, we had no director. At least she was very new. Now we have a serious capacity. She's on board, and she's in charge of the operations. We feel that we are really well equipped. Thank you, Chair.
Just a minute. Allow me to. This committee looks at the law. We don't look at the generalities. I want us to look at the Public Audit Act. I want it to address the head of finance. Public Audit Act, read together the PFM. How, in terms of how it recognizes reconciliation. Therefore, if you say Kentrade and PesaFlow are not able to give you information 2 years later, 1 year later, then I want you to comment. What does it now refer to when it comes to the PFM Act, to read together the Public Audit Act, with respect to reconciliations?
Thank you, Chair. Definitely, you cannot confirm the amounts. However, I'd like to state that during the audit, we had reports. We had reports from Kentrade and PesaFlow to support the figures that we had in our financials. What we didn't have is the detailed reports on the customers, and that's a different platform. We needed another access to access that kind of report. And that's when we engaged Treasury. We are now able to access the detailed reports that shows which customer paid for what and for which service. We did have reports.
Just a minute. When you say reconciliation, in Christianity we say give to Caesar what belongs to Caesar.
Yes.
So when you're doing reconciliation, you allocate monies across. It means you're giving debtors, suppliers, and everyone what belongs to him. And when you say you are not able to get data from Kentrade with respect to the invoices and customers as in totality, it means Kentrade and PesaFlow is not serving you. Is that the position? So that we now need to go deeper into the situation. Is that the position?
Chair, the challenges we've been having is to access those reports real time. Now we are able to access them. We've had several engagements with the National Treasury on this.
So you say 2025, 2026 will not have similar issues?
No. We were able to resolve this matter.
What was the issue?
Accessing the detailed customer reports. And then as well as the issue, we've brought in the issue of integration of our licensing platform, which is IMIS, integrating with these payment platforms. that will also make it easier for us accessing these reports.
Thank you. See, I want you to look at the letter, page netted 1109 on your document in the file, the annex file. (1109). CEO, you've seen that page?
I have seen it, Madam Chair.
Do you have any mistake on it?
Yes, I confirm there is a mistake.
What is the mistake?
The date of that letter.
So do we get a proper date, a proper document to that effect?
Yes, Chair, with your permission.
I hope this is not just cooking for the sake of our report. Colleagues, you know, this appears to be a document from yourselves to Ezron just after the invite for audit review. Is it really delivered later?
Yeah, we can confirm, Chair.
Meanwhile, can you ask that you withdraw that document and give us the right document to that effect?
I'm well guided, Chair.
I also want to confirm, I want to invite you to the question on I want us to look at the audit query on the hot water, construction and equipping of hot water treatment plants. And help me to walk through and on this one I'll be looking at maybe two directors, procurement and finance, so that you help me to really understand. You procured this hot water at 85 million shillings. At the time of retender, you retendered the document, the project, and awarded to Trademark. The one I know is Trademark East Africa. I don't know this, the same one or these are different. You've written as Trademark Africa. Is it the same as Trademark East Africa?
Yes, it was upgraded to Trademark Africa.
Maybe the head of procurement at the point of this will have to confirm if it's the same. But the response you've written is Trademark Africa at the amount of 65 million. By the time you are tendering, by the time you are closing the old balance, old tender, the performance was at 70%. That's your own notes. And when you look at 70%, meaning the work remaining was 30%. 30% of 85 is roughly 25 million shillings. You have now tendered for 30% equal to 25 million and now paid for it at 65 million. May I get the explanation for that reason? And if there was value for money to that effect. I also want you to go to your own annex, page 923. When you look at annex, you are paginated 9 C1, Roman 3, page 923. When you look at the workings, to look at the chart of that project, it details to you the percentage of works completed as at that time. And when you look at the date, that's minute 14 of the site meeting held on 26th February 2025. So, CEO, I want you to help me understand what might have happened.
Yeah, thank you, Chair, for the questions. And I would like to request the procurement team, my procurement director, to respond to this question.
Maybe before she responds, allow me to invite my colleague to introduce herself.
Thank you, Chair. My name is Fatuma Jeho. I'm the County MP Wajir and a member of this committee. Thank you.
Proceed.
Okay, thanks, Chair and honorable members. At first, this project was the first tender was for the procurement of the building and the equipment, which was coming to the 85 million. Then when you say the percentage that was left out, the 23% was the machinery. The contractor was not able to fully deliver the contract for supply of the machinery for the equipping of the hot water treatment plant.
You are now making me get more. What do you mean? This minute in C1-3. Maybe help me to walk through. What is he talking about so that we can know?
Which minute?
Proposed contract. That's the same. Park house, yeah. So.
Okay, Chair, we are trying to understand the minutes and the response. The 70% was actually the building alone. So meaning the 30% was not concluded on the building. So when he tendered, now the trademark did the assessment and new BQs for the building. So definitely they came up with new BQs to do the building. And that's why now we are seeing you're questioning the trademark did it at more price than what we were expected to pay for the building.
Maybe let me reframe the question. What is 85 million? What's this 85 million that you tendered for?
The 85 million was for the building plus the equipment.
Building plus the equipment?
Yes.
And when you look at the auditors, let's now walk through as per the auditors. By the time you are winding up, you had paid 47 million, 036,203 shillings, as per this C1 sub-item 3.
Correct.
Am I correct?
Correct.
You went further to tender afresh for the same supply of equipment and construction at 65 million, meaning total project cost is 47 million, 36, 203 plus 65 million. CEO, when you add the two, what do you get? Maybe this is not for you, it's for you for the head of finance and the head of procurement, so that they let us know what I'll ask what I'm looking for. How much does it come to?
Around 130 million.
No, 112. 65 plus 40 plus 47.
130. Oh, 112.
It's 112.
Yes, 112.
So CEO, maybe when you what's the change in cost? What's the positive change in cost? How much? 27 million?
Yes, about 31.7%.
That 1.7%.
You see, Chair, maybe if I can come in, these are two different projects handled by different entities. I'm saying what was handled by the trademark now was enhanced. Like the building, they added more features which were not there before. The equipment, these guys were not able to deliver this equipment. Basically, maybe when they go into the market, the equipment was more expensive. So when the trademark did their assessment, they gave us more specification, a wider scope of the equipment. And that's why that is bringing this difference.
Is there a change in the title of the project? You see, the purpose of this committee is to help you.
Yes.
Is not to blame you. Is to help you so that you see why the PIC is existing. Was there a change in project title? You still procured under the same item. Am I right?
Yeah, though the tender was done it was done totally by Trademark East Africa. The retendering of the building was done by Trademark East Africa, not by Agriculture and Food Authority.
Not?
By Agriculture and Food Authority.
It was done differently?
Yes, by Trademark East Africa.
Yeah, maybe, Chair, if you could look at the insert 3, we saw that when Trademark Africa came on board, they looked at this, what we were doing, and as she says, they improved the capacity. And from our insert 3, you find that they did hot water treatment, retrofitting of pack house and parking area floors. So some of the things that they really added a lot of value, and they did that tendering because we see them going as far as doing some of our pack houses outside, even in Nairobi, outside the hot water treatment. So they improved on what we had started in terms of the capacity of the machine, the equipment, and doing other things.
Remember, the initial discussion was 79 million, as the estimate was to be shared between a donor and GOK. The donor whom you have said in your response did not show up in the first instance. So he's coming up at the latter minute, the late hours.
No, this one we had to look for, to source for donor.
No, but you see, when you look at the response, project financing and engineers estimates, the 79 million in the concept note was initial estimate subject to. When you look at that 79, it was to be shared between a development partner and the national government. So the whole concept was to be shared by a developer and national government, whom later on did not. So you are saying, I know Trademark East Africa is a regional development partner who shares programs and projects for institutions. So do you want to say that the top-up was done by Trademark East Africa on its own? It was not by AFA?
No, they came in and did it on their own, as the director supply chain has said. They returned that afresh to include some other aspects that were not there in the beginning.
Can you then help me harmonize this percentage? The audit, the director of audit has picked 57.7%. The minute number 14 picks the project at 70%. Can you reconcile for me the difference?
Sure. The 57.7% is also their figure. It's in the response, not in our audit issue.
Yes.
It's part of their response.
It's also part of confirming with their response.
Yeah, what we had issued earlier was that the 70% was just the construction, the building itself. But now we are coming to look at the entire project, including the equipment and fitting. Now that one is that's what we are coming up with, 57% in the response, 57.77%.
It cannot be the equipment. When you are taking 70%, he has taken 70% of 85. And that's why he has come up with 47 million.
Yeah, 47 of 85 actually is 57%, if I'm not wrong.
Is how much?
57%.
57%.
Yes.
So this 70 was for the building?
Yes, for the building only. The construction, the works.
Any more clarification, Kithinji?
I think it's getting more confusing because the amount that has been paid of the 47, if it's the one that is giving us 57.77% as part of the cost of the building, if you go again to the 70% completion date and the 30% remaining, then it means if the machine was costing around 25 million from their BQ, if you minus this one from 85, you get a figure of around 60 million, meaning the amount that ought to have been paid for the building would have been around 13 million. Plus now the equipment of 25, going to around 38 or 39 million. So although enhanced to 65 million, then we need to see what were the new components that were enhanced to make it 65 from that 8 million.
Because Chair, when you open page 1007.
1007.
Yes. You see there was specialized equipment and planned installation. It was coming to 11,750,000, which was actually the equipment, which when you add VAT plus the rest, it's coming to our whole contract was 85. So maybe management need to demonstrate that fine. The 57 being the structure, what additional component was supposed to be added to warrant 65?
Proceed.
Thanks, Chair. As I said, this tender for 65 was independently done by Trademark. As I'm saying, AFA was not involved in that tendering process. They did it solemnly alone. So
I want you to know the difference between a development partner in air and on land. Who is this horticulture? What was being done? Isn't it your project?
It is our project.
So can you say you got a friend who donated for you? So you cannot run away from responsibility.
No, what I'm running away is the tying them together.
No, you have to tie them together because they were doing your project. It is you who did the concept note. And it's you who invited Trademark East Africa as a friend to take care of your financial gap. So you cannot run away. And that's why this figure is in the books. The 65 million is in the books because these are your friends.
I agree, Chair. Then the percentages, we cannot be able now then to tally the percentages because when Trademark now came in to give in the new BQs, as we are saying, they added more features which were not in our.
And now those are the issues we want to get. That's why the Director of Audit here is saying, give us what was there. First of all, just draw a comparison. Initial tender was 123, which he has come up with, looking at the 11 million on machines. When you build it up with the building, it comes to 85 million. Now, we are talking of a cost of 112 million. What I'm looking for is value for money. What I'm looking for is misuse of money. What I'm looking for is to know, to apportion what belongs to you and what belongs to somebody else. So can you just have a tabulation? You might not have it now, but have it as a take home. Give us item 1, being the old contract. What were the elements making up the 85 million? Item 2, can you add 65 plus 47, making it 112? Can you then build for us the items which you feel came on board and were not in the initial contract? Then we can now be able to explain. I think that can be a take home so that we move forward. See, I want to ask you this issue on machines by Nzoia Sugar. I can see you are spending some money and the new lessee has come in and taken away some parts. I want to have, first of all, I want to have the contract that you entered between yourself and Nzoia Sugar, warranting you to give them 256 million. What were the terms? Were you to pay? I can see you generated LCs. Any annexes to explain the relationship between yourself and Nzoia Sugar? And my question number 2, I want to know, why did you procure the existing using existing contracts of 2022 and those of 2024? in 2025 or in 2026. How can I confirm that indeed this procurement existed? I highly doubt that the procurement existed, because you knew the leasing discussion was going on. Because that discussion of leasing was not new. It's something we had been in the discussion for quite some time. I also want to know, at what stage did you allow the new lessee to access part of the items? Why not take all? Why not clear everything?
Yeah, thank you, Chair. Yeah, as how we had indicated in our response, it's the tendering was done by Nzoia Sugar as an annual maintenance program where they did to maintain their boilers in 2022, as you have indicated, Chair. And these two companies were given the tenders to supply at the cost that I had indicated, that $99,000 for blank mill boilers and rollers, and then $225,000 for the boiler tubes. So the Nzoia Sugar at that time did not have the financial capability, so they wrote to the Ministry of Agriculture to assist. As I had answered in B, that the ministry facilitated this by establishing a letter of credit that amounted to 43 million Kenya shillings to settle the suppliers. So this was actually not a contract between the Nzoia Sugar and AFA, but it was done through the parent ministry. And these machines were delivered.
Allow me, CEO, at this point there is no ministry. There is no books maintained by the ministry. Me, I'm looking at the money that you released as AFA. So whether you release on the request of the ministry, that is now background between yourself. Because I'm just asking, the money that the auditors picked is the figure of 256,599,000, which to you disperse it to Nzoia Sugar Company. So before you disperse this money to Sugar, to Nzoia, can I see the relationship between yourself and Nzoia Sugar? It's the same part of this. Response.
Yeah, Chair, I would like to confirm the letters that we got that enable us to disperse these funds. So I was requesting if we could provide the letters that prompted this disbursement.
You have the letters?
Yes, I'm confirming, so that if they are available, we provide to the House or later on.
You know, you are the CEO. You cannot say you are confirming whether they are available. You state it in affirmative whether they are there or not, so that we know what to say. You have the letters, or you have or you don't have.
Yeah, we have the communication between us and the ministry. So
and the ministry.
Yes.
So the ministry authorized you to release this money to
Nzoia Sugar.
To Nzoia Sugar.
Yes.
Therefore, we need the letter from the ministry giving you authority to release the money to Nzoia Sugar. In your response, you have apportioned this into 2 lots. You have said Christina Engineering was awarded to supply the blank mill rollers. So between the two, the blank rollers and boiler tubes, which one was cleared? What was cleared at the port?
Yeah, the boiler tubes. Chair.
The boiler tubes.
Yes.
Whose cost was $225,000.
Yes, yeah.
So those ones have been cleared.
They are cleared.
Now,
by the lessee.
They were cleared by
the lessee.
By the lessee.
Yes.
By the time you are leasing, was this part of the cost of the equipment?
Yeah, because we know it was leased in totality, as is, with the assets and liabilities. So.
But you spend this one after the lease, not before. You also
no, it was before, Chair, because the machines even had arrived by March, April, before the lease. Lease was done in May.
And that's why I wanted to know your relationship, so that we agree. Let us know. Are you not just giving a donation of this $225,000 to the lessee? Because he was not entitled to this. But you have given him $225,000. He has leased your factory. You've again given him $225,000 worth of equipment.
Yeah, Chair. Maybe allow me to say that when these leasing was done in May 10th, these machines were already at the port of Mombasa. They were just awaiting clearance. Unfortunately, Nzoia Sugar did not have finances to clear the machines.
Had you issued the LC already? The LC had been issued?
Yes, this was issued earlier. It had already been issued.
How are you? That's why I'm asking you. How are you comfortable? Where was the comfort of AFA when it comes to this 256 million shillings?
Yeah, actually, as I had answered the Chair earlier, is that
is this a donation? Is it a grant? What is it?
No, it was we were facilitating Nzoia Sugar to maintain their machines.
Is it within the mandate of AFA?
Yeah, at that time when Sugar Board was with AFA, we used to extend the funding or facilitating the factories as well, where necessary, especially when we got the recommendation from the ministry.
As a donation, a grant, what was it? You know, see why I'm asking you all these questions. We also oversee Nzoia Sugar, and we have already read the books of Nzoia. Nzoia was where you are before, where you are seated, and we know what happened with Nzoia. So give us your side, so that we also come up with a proper way to advise, because we know what we are asking you is not what you are responding to. And if you ask Kotut was where you are, there. And what he has given us is totally different from what you are saying. So can you tell us exactly what is correct?
Yeah, I'm sorry, Chair, for that, because this response that we have here actually was provided by Sugar Board.
Sugar Board is behind you.
Nzoia
Can you
Sugar.
ask the director to tell us? He's there.
By Nzoia Sugar, sorry. Nzoia
Yes.
Sugar themselves, Kotuti himself,
Yes.
as I had quoted this letter that he sent to us, this response about the status of those two parts. So this, as you had asked earlier whether it was a grant or a donation. Yeah, it was a grant that AFA dispersed to Nzoia Sugar from GOK funds.
I wish my brother here was able to speak.
Yes.
You know, see, you are a cane farmer, and I'm a great follower of what is happening in the sugar sector. And I'm the owner of the Sugar Act today. Please, give us what we are asking for. And where there is a mess, it must be explained. People should not take taxpayers' money for granted. Nobody should just wake up one day and access $25,000 just on a silver plate and says, here I am, I'm going to clear the goods. Yet he had already leased the machine. At the time of leasing, this was not part of the lease. Immediately after the lease, he accesses the money, he can clear the machines and goes away with it. Isn't that theft? Where you take what is not yours. Are you not stealing? Colleagues, anyone with Bishop add something? I want to ask you the final issue on this one. I want to get, yes, Director.
There was somebody from Kenya Sugar Board. I don't know whether he has the same explanation.
The Director from KSB. Are you under oath? Engineer? Yes. Talk about this, because this is...
Okay, thanks, Chair and members. The government mills that were leased out many times would get into financial challenges and would go back to government for bailout. So Nzoia Sugar, it happens this time round, having placed these orders, they had no money to pay. They asked for a bailout from the Ministry of Agriculture. So the ministry then released the money to AFA to pay. So it is AFA then that paid on behalf of Nzoia. If Nzoia had money, they would have paid themselves. Now, as indicated here, these parts arrived in March and April 2025 before the leasing happened. If Kotut had money then in March 2025, he would have cleared the items and brought them to the factory in Bungoma. But because he had no money to clear them, that's why he was again still looking for money from the government to clear the goods from Mombasa. But before government gave him any more money to clear the goods, the factories were leased out. Now the lessees were to take over the assets of the existing mills. Now the challenge that the Leasing Transition Committee has faced is that now the old Nzoia is no longer there. It has no money on its accounts. It had equipment in transit that hadn't been received. So who now clears that equipment? And even if you clear it, now where do you take it? You have no factory. Some of these items are specific to specific equipment in those factories. So even if government was to clear this equipment from Mombasa, it would then have to have a way of selling it to the lessee.
Actually, just end it there. That's the point I'm looking for.
Yes. But now...
Just a minute, engineer. That's the point I'm looking for. And the government should get back that money from the lessee. Because by the time they were leasing, the factory did not have those equipments. So it's only proper that now Nzoia Sugar through you, who says you funded the equipment, at that time the lessee is taking the equipment, he should now pay for the equipment. Because it's not the old Nzoia that you entered into agreement with. This is the new Nzoia. So he should pay the 225 back to you. What you just said is what I was looking for. So CEO, this is money which West Kenya owes you. You need to get it back. The $225,000 must be paid back to you. But first give us the agreement. Give us the contract with which gave you this. The other bit, engineer, there was so far no evidence at the time of audit that these machines had been installed, had been delivered and put into use by Nzoia Sugar Company. Were they really cleared for Nzoia Sugar Company?
You mean the equipment that was in Mombasa?
Yes.
The boiler tubes were paid for by West Kenya and delivered to West Kenya and not to West Kenya, to Nzoia and installed in Nzoia. But the other parts are still in Mombasa, not cleared.
That is what now confirmation from the auditor's comment. That's where now the auditor is saying there was no evidence.
Okay. Then the evidence can be found.
Yes.
Okay.
So if we can have a confirmation or evidence that true, these are the equipments that were delivered to Nzoia Sugar, then the auditor will sit comfortable. Okay. Yes. West Kenya has many factories. He could have cleared for another boiler, not for Nzoia Sugar boiler. And that's why now when he clears the goods, they become his. They're no longer yours. So he needs to pay for them so that he can take it anywhere he wants. Colleagues, we need to move. I need to go to the last issue, the issue of interest on cane testing units. See, I want you to help me understand this cane testing. We've been on this issue for quite some time, and Engineer Makero has been on it for some time. He is a very seasoned officer when it comes to this issue. What is coming out that there was no legal framework? Maybe help us beyond what you have explained in the response. What is this we are saying legal framework?
Yeah, in simple terms, Chair, these are regulations, but I would like, if you may allow the engineer to put some more light on it, because there were no regulations at that time. So if we may pour some more light.
So thanks, Chair. As the DG has said, the legal framework means basically the regulations, the enabling regulations that would allow the payment based on quality to have a force of law. Now, we have drafted the sugar payment system regulations. They have gone through the preliminary stages, and as at the time of audit, they had not yet been gazetted. Now, we had targeted to finish this in 2025-26. However, Chair, we are having a small challenge because where we had reached, we needed to do the final validation with the forwarding to the...
You've gone too far. Go to the head of finance.
Okay.
Head of finance
Sorry.
or director, you went ahead and pay because he has confirmed there are no legal instruments. There's no legal framework. And you know the PFM Act protects you or stops you from paying money to where there is no legal framework. And you are the custodian of that document. Why did you proceed and pay? Yet you knew very well there was no legal framework to that effect.
Chair, this was payments for every year.
you are not right. In the first place, when you look at the issue of the 456 million, that includes acquisition.
No,
It
this
doesn't
is
include
maintenance.
acquisition, it's maintenance.
Yes.
So by the time you're acquiring the CTU, did you have the legal framework to acquire the CTU? Because the concept for a project flows from acquisition to maintenance to processing. So by the time you're acquiring the CTU machine, did you have the legal framework to acquire the CTU? That's why I asked, why did you then proceed and...
Chair, can I say something?
Yes.
Hence were procured under the Public Procurement and Asset Disposal Act as assets. The legal framework that has been missing is the one that will allow operationalization, that will force the millers to agree to pay farmers based on this system. But I believe the procurement fully followed the Public Procurement Act.
Allow me to put it this way, engineer. Why do you buy land? Because you want to use that land. You are benefiting out of acquisition or owning that property, what you call an asset. Now, the audit here has laid bare that none of the 11 CTUs are working. Is there any that is working, contrary to what the auditors have said? Out of 11, do you have any that is working?
All the 11 CTUs are operational.
Okay.
What is not happening is that they are not being used to pay farmers based on quality. It is possible that at the time when they visited these government mills was just after the leasing happened, and the CTU can only work when the mill is working. So when the factory is not milling and receiving sugarcane, then there would be nothing for the CTU to be testing. So it's possible that they visited the former government mills when they had stopped for maintenance, because when the leases came on board, the first thing they did was to stop those factories, do some rehabilitation before they started operating again.
You know, engineer, you and me come from this Kent zone. I've never been paid using the CTU. I've never.
True.
And colleagues, allow me to state it very clear on record. My farming CDO 34 is dated 11th August, the year 1984. That is when I started farming Ken. I've never been paid using CTU protocol. So it's not working. So auditors are right. Whether you visit the factories at night or in the day, they are not working. So engineer, please call a spade so that we correct the situation. What I can confirm here is it's a good project. To be good is good. Engineer Magero, it is a good thing. That is the way to go. But since it has no legal backing, I as the chair PIC cannot just support it until we get the legal framework right. It's a good idea, but born too early. So let's put it to perspective that we are not doing the right thing for now. But the idea is very noble. CEO, I can't say I'll agree with anyone who wants to stop the idea of CTO. It's a good thing. But legally, where did we go wrong? We went wrong by procuring without the legal framework. And when you look at your response, CEO, you are still promising, not telling us when are you finalizing the legal framework. But had you said you are finalizing in the next 2 weeks or 1 month, then this committee will listen to you.
Yeah, Chair, thank you very much. Actually, these regulations, as we have indicated here, they require different steps. On our side, we have done what we could, but now we're waiting for public participation, and then it's being enacted.
Let me give my colleague to introduce himself, and then we proceed with Bishop.
I think he did.
You did?
Thank you. Mabogo Inaina, Member of Parliament of that constituency, and a member of this committee.
Bishop?
Yes, I was just adding to your number of insights and insightful questions, Chair, that in absence of required regulations and policies, resolutions of the board would play the gap. I'm not hearing that the board then decided all that, and so that it guides management, doesn't appear like an act of management only. Where is the board in this, so that it can shield you, that we didn't have regulations, but what happened at that time, because it was a necessity, we required, the board sat and advised and sought an advice from the ministry, blah, blah. Those are some of the corporate stopgap measures in absence of certain regulations. The board exists to bridge the gap. So, Jay, I'm not hearing with the repeated questions as the management presents themselves. Thank you.
In addition to what Mheshimiwa said, then you make a comment. I want you, CEO, together with the director, now that CEO, you might not be very interested now that the sugar has left you, but I'm sure the director down there is very keen on this issue. No, it's a fact, CEO. It's a fact. Yeah, so I want you to look at the 11 issues raised by the Auditor General on accreditation. And very key, I'll be looking, Director of Audit, Dr. Mayo, I'll be very keen to look at the audit of 2026-27, 25, 26, 26, 27 from Kenya Sugar Board, when they appear before us. These 11 issues, Engineer Makero, are very key, cardinal to the existence of CTUs. If you not have achieved them, then definitely we will not be having any discussion about it. We should call a spade and say, this is wasteful use of resources. Lack of quality manual procedure and policies, the issue on incomplete results of successful participation in proficiency testing, the issue of resumes of nominated technical signatories, mandatory procedures and documentation as required by ISO 17025/2017. Those are cardinal issues. So I would want you, Engineer Makero, when you resume back to Kenya Sugar Board, give it to us for us to be able to imagine that CTU is anything to move forward with. I want to hear Director of Audit.
Thank you, Chair, for that critical query. In 2025-2026, this contract was being run by AFA. So it will still appear in 25-26 in AFA, because this contract is supposed to end in October 2026. It was a 3-year contract. And that contract was signed between AFA and the supplier. So it is a running contract, say that Kenya Sugar Board now, when they take over, it means they will take over under a new terms. But those equipments are there, but they are not integrated to the weighbridge so that the farmer can benefit. So with this old contract, maybe Kenya Sugar Board should come up with the strategies on how they are going to inherit, maybe in their inheritance, how they have really handled. Thank you, Chair.
And that now adds me to the final question before, as you submit to the 2 issues raised by Mheshimiwa and myself. 456 million shillings was for maintenance. What is the cost of the 11 CTU machines?
Yeah, Chair, thank you very much for the queries. One is that allow me to confirm the total cost because they were purchased at different times. They'll be given the toting now. I don't want to quote the wrong figure about the total cost of the 11 CTU machines. And on the role of the board, what the honorable member has asked. Yeah, the board's advice was for us to fast track the regulations, because that's the only legal framework that these machines can be utilized by the farmers. And without the regulations, we have not been able to use. We could only test, but we could not use them until the regulations have been passed by Parliament. So that is why we have undertaken the rigorous process of drafting and going through all the processes to ensure that these regulations are fast-tracked and enacted for us to start operational using the machines. But the board's advice was for us just to ensure that we fast-track the regulations which were drafted in 2025. Thank you, Chair.
CEO, when are you giving us the cost, the estimate? Not the estimate, the actual cost of the CTU, 11 CTU machines?
Okay, we can give as a written document.
Yes, you'll submit in writing when we, together with any other issues that we have raised today.
Thank you, Chair.
CEO, I'll try to cruise through something. In your, allow me to take you to page 20 in your response. The qualification of 85 million on that hot water. You confirmed that the variation is allowed at 20%. Maybe if you can help me get the law that supports the 20%.
Yeah, Chair, thank you very much. Let me confirm with the procurement director.
Give her the mic. She's there. Why do you want to confirm it? She's there to support you.
Yeah, she will support.
Yes. Give me the section and the law so that I can know. Maybe teach me some procurement laws today.
Yeah, the contract variation is a maximum of 25% cumulatively, 10 and 15. So if it's 20, then it is within the law. 130. I can't remember the section. It is 130 something. I can confirm it.
At what stage do you say a contract is being varied? When you are procuring a contract is not, is it called project variation? See, you can only dress a child that is walking. You cannot dress a child that is stagnant. So when you are saying 85 million, the auditor is querying the variation of 85 with respect to 79. He is not varying, he is not asking variation of a project that's working or work in progress. No. He is asking you, why did you move from 79 to 85? That is the query the auditor is asking. So this 20% does not exist.
Yeah, well, get it, Chair.
CEO?
Yeah, Chair, I'm well guided that it doesn't apply because we had said that we had done this before the BQ. So what you have said, I'm well guided.
I want to hear from Director.
Chair, what they have really, I think they should really delete this. They should expunge this by 20% because it's going to really mislead the committee in writing. Because we are comparing a budget which might have been in procurement plan against the actual contract which they have awarded. So they should not really bring in the variation. Maybe they should explain why they moved from 79 to 85. Maybe they had extra budget from somewhere, but not comparing percentage.
I can confirm to you that my team will not be misled by that. Instead, this is a very good response that they were unable to explain. Completely, they are unable to explain why they moved positively from 79 to 85, because there's no justification. So the remark is very clear. They did not confirm. So we hold it that way. Unless you have a contrary.
Yeah, Chair, actually what we had said earlier was that when we were doing the 75, 79 was based on the concept not before the bill of quantities. So the bill of quantities came, they raised the figure to 85. That's the justification or the reason we have.
That's okay. Colleagues, anyone with any remarks? Okay, Mr. Moderator. Thank you, colleagues. There is any comment from your side? Allow me to give Director of Audit any closing remarks.
None.
CEO, any closing remarks?
Yeah, I would like to thank the chair and the honorable members for having been with us. I remember on several occasions we had to postpone this sitting, especially when our DG could not be available. You really accepted our request. I'm really very grateful, and we are looking forward to complying and taking in all your advice that we have had today. Thank you very much, Chair.
Thank you, CEO. I just want to wish you well and wish the organization well. Dr. Linyiru was a very strong CEO, and we really worked with him up to the year 2023-24. And as you come in for 24-25, which you have concluded today, just take note that one, should we get a mistake in your response, we'll invite you again to come and clarify. We don't just report where we have no clarity. So should we get an issue in the queries that have been raised and your response is not sufficient, we'll call you back so that you explain yourself properly. But for now, I want to thank you and your team to have taken time to explain yourselves. The issues that came, the gaps that have been found in the discussion, please make submission in the next 10 days so that you have it with us by 15th. Or say 14th of this month, so that when we go to report right, we have everything covered in what you are able to explain. Otherwise, thank you. We wish you well. We adjourn the sitting.